Hello again and welcome back for another edition of London Direct. Time just flies, another earnings season is upon us, and I've been previewing it with Mike van Dulken from Accendo Markets, and we started by talking about the situation in the US. There's not a lot more to say about the US political situation, but I'm just wondering why we haven't seen a more aggressive sell-off in US equities, and also why aren't we seeing Treasury yields really shoot up?
I think markets are convinced there will be a solution. How long we have to wait is another matter, but we've been in a similar situation before and they did muddle through in the end, albeit being going right down to the wire. So I think markets are concerned but not terrified, hence why we've not had a huge sell-off as you might have expected. Of note on the Treasury, don't forget that the 1 month paper did see a spike in the yields last night after that auction. Very low demand, very high yields, which is on the short side, the short-term side, that is a message of credit risk and concern. But
the US could default, right? I mean, in theory, if this was Italy or Spain, the yields would be going through the roof, and at the moment there's no plan in place, but the markets just don't seem that concerned. It seems a bit strange.
I mean, don't forget, a couple of years ago we were worried about the US losing its AAA rating, and it's plodded on for another couple of years without having a AAA across the board. As you say, technically it can default. Whether that's the end of the world is not the right phrase to use, but whether it's disastrous is another matter. I would imagine, Treasury Secretary Lew is already being creative as an accountant in getting things carrying on working until as far as possible. I would imagine afterwards they'll be able to prioritise payments towards sovereign debt, which means there's no default on that front. Whether you count a default not paying other things is another matter, which maybe the ratings agencies would have a bit more to say on.
Just a quick word on Janet Yellen. Seems like she's going to be the woman to take over from Ben Bernanke. Isn't she just Ben Bernanke but with more qualifications?
Yes, and I guess one of her key qualifications is having been his subordinate for so long. The markets aren't exactly rallying on the news because it has other things to be concerned about, but it likes the idea. We already knew that Larry Summers was out of the picture, and markets like that as well. It was then that we took Yellen as being a shoo-in. Now we've got pretty much the confirmation. All there is between her and the post is the Senate Banking Committee actually giving its seal of approval, which shouldn't be an issue. But the markets do like the idea of continuity, of her carrying on very similar policy to what she is part of right now. And this is at a time when markets are trying to work out when the Fed will start tapering and how long rates will stay low and how long a policy will stay accommodative.
Yeah, I just want to move on to the UK earnings season. We had Alocoa in the US last night, kicking off the US earnings season. UK earnings season's just around the corner. It's quite depressing how quickly it comes around again. I know we're going to look at 3 different sectors, starting with the housing sector. It seems UK housing sector's just got one side at the moment, and that's the upside with all these government initiatives. Is that a fair comment?
I think it's certainly going to be a very supportive factor in the short term. And if you look at many of the price graphs, you'll see that while most things have come off their recent highs, these look to have an element of support, and the new initiatives, as contentious as they may be, Help to Buy, whether it's inflating a bubble, etc. I believe that is going to help out not just the house builders, but also potentially the banks, which we'll talk about, and don't forget things like estate agency. We've just had Foxton's IPO. The shares have done very well, and do they have now support from potentially a stream of properties and more transactions going through?
Yes, so what about those banks? It's always really interesting because partly they're exposed to the UK economy and through this Help to Buy schemes and the like, but also they're so intertwined with the global growth picture that it's hard to pick how they're going to perform.
Yeah, it's the UK banks. We would normally look at the US banks reporting season as a sign of how things might be in terms of trading, etc. But don't forget, our real banks, if you like, the troubled ones, the ones that have been rescued, have been trying to shy away from too much of that risky stuff in order to be more solid and less risky, in which case those elements aren't quite as important as they were. So yes, earnings season's just around the corner. I think the government initiative, the Help to Buy, is in fact designed to bolster those UK banks. When I talk about those, I'm talking about the RBS and the Lloyds, the ones which the government have a big stake in. But those things could help boost its mortgage book, could help it do a bit more business, could make them look a bit better in light of the 2005 upcoming election. So it's not only bolstering the electorate, who'll be able to buy houses more easily, but also we've already had Lloyds a stake sold. The shares have not really gone anywhere since. I do wonder whether there's a bit of a cap on them, with the government selling out at very close to the rescue price. But whether this is all orchestrated towards making things look better as we move towards an upcoming election.
Yeah, let's just finish with the Royal Mail IPO. There's lots of discussions whether it's overpriced or not. I'm just wondering what the retail client's access is to the Royal Mail, because once you have all the hedge funds and all the Royal Mail employees get their shares, is there a retail story there as well?
It's a big debate. I had this chat with someone yesterday, and to be honest, we didn't come up with a final answer. There's two possibilities. Either the shares go predominantly or a lot of shares rather, go to the institutions, and the bigger the stake they have, potentially more of a lock-up, which ensures some stability. Or the government looks, again, more towards election and electioneering, getting as many shares out to the public as possible to make it attractive and to get them involved. However, if these shares do, and the grey market is hinting that they could open around the £4 level, that's so far above the 330, do you end up with just the shares being dumped for a quick flip, which would not be really good in terms of stability. However, I forget, in terms of book runners and stabilisation, they'd only really have to step in if the shares were toying with the actual IPO price, which is going to be the top end of like 330. So, you know, the shares, for me, if they do list around there, there's this huge demand that people see it going further and further higher. If anything, there might be could be a little bit of a disappointment on IPO day, which is Friday when conditional trading starts.
Thanks to Mike casting his eye over a wide range of topics. Stay tuned to Dulken's Coffee TV for more interviews, but for now, goodbye.